Hi, welcome to today's podcast where I'm going to be looking at clubs and societies, and in particular receipts and payments account, subscriptions account, and profit and loss stroke income statement for special activities. A few key terms because you're new to clubs and societies. We don't use the same terms for our financial statements. We do for some of them, but not for all of them. So the income statement, we're now going to call an income and expenditure account, but to all intents and purposes, it's an income statement. Statement of financial position, nice and easy. We're going to call that a statement of financial position. The trial balance strict cash book is a bit of a strange one. That's replaced by the receipts and payments account that I'm going to show you very shortly. And we don't refer to capital anymore. Capital belongs to the owners. Accumulated fund is what we call the equivalent of capital in a club and society, and that belongs to the members of the club. Okay, so receipts and payments account, well, what are they? Well, the receipts and payments account is a summary of everything that the business has either received money for or spent money on. So what you'll see in the exam will be a club in this case, the Valiant Football Club, and you're asked to show what their receipts and payments account will look like for the year on 31st December 2016. You'll be given an opening balance, and normally that will be on the debit side. Okay, and then these two, cash from reduced sales and subscriptions received, that's money coming into the business. So because it's money coming to the business, think like we would in the cash book. Money coming in the cash book, we're increasing an asset, and therefore we're going to debit the receipts and payments account. The remainder of these transactions are things like rent of a pitch, that's where we're paying money out, payments for juice, paying money out, payments for strips, paying money out, groundsman wages, payment for juice seller, electricity, and insurance, all things that we pay money out. So thinking of this as a cash book, they will all go on the credit side because although they're expenses, we're looking at what happens to the cash, and the cash is reducing, we're reducing an asset, and therefore we put all those entries on the credit side. Okay, debit side is bigger than the credit side. So 33,000 is going to be the balancing figure. Okay, and then we're going to have a balance brought forward. So 33,000, take away all the cash expenditure, gives me a closing balance or a balance carried down of 3,700. Right, as you'd expect, I've done a couple of examples, or one example for you guys to do. In this case, it's a running club, so pause the cassette or pause the podcast, complete the question, and then come back for subscription accounts. All right, subscription accounts. A subscription is money that a member pays into the club to be a member of the club, normally for a year, sometimes for a longer period, sometimes for a shorter period. It is an income account. It's no different to what we did in accruals and prepayments. So there's nothing new here. Okay. Looking at the easy transaction, first of all, the receipts in the bank were 20,000. We know already that that's a debit in the bank, and therefore it's got to be a credit entry in the subscription account because it's a form of income. So with incomes, we debit bank and we credit the income account. Now these ones are a bit tricky to think about, but they're not too tricky to think about. We've got a subscriptions owing on the 1st of January 16. So that means that some of our club members had a subscription last year but didn't actually pay it, and therefore they owe the business some money. So these are going to be an asset. So the balance brought down for the subscriptions owing is an asset. And if you think about the logic, this 500 is going to be paid this year, but it's not part of this year's subscription. So that looks right. We've also got some subscriptions prepaid. So at the start of the year, a subscription prepaid or an income prepaid is money that the business or the club owes to its customers or to its suppliers. The club members. So what we need to do with that one is to put it on the credit side because it's a liability. And if we think about the logic says that money is part of this year's income. We've got 2 more subscriptions owing and prepaid at the end of the year. Well, the first one here is a subscription owing by members at the end of the year. That will form part of this year's income because it's what's been earned this year by the club, and it will be a asset at the start of next year because it's money they can go and collect. We've got some subscriptions that are being prepaid. Well, they don't form part of this year's income, and therefore, although they're in this year's money received, we need to put them on the debit side to take them out. And if we think about the logic again, they are going to be a liability next year because if the club were to fold, it would owe that money back to those club members. Balance off the accounts. Okay, 20,750. I now subtract 450 and 500, and that gives me the amount that belongs in the income and expenditure account, remember, not the income statement. Example for you guys to do here with the Kes Running Club, and then come back very quickly for a final little bit on income and income statements. Okay, final little bit on this podcast. I know there are lots of little bits. None of this is actually new though, is we've got to do an income statement because the club does an activity to generate profit to help support the club. In this case, they sell juice. In the example that you're going to do, they sell burgers. And we've got some additional information down here. We know the opening inventory of juice, closing inventory of juice, but we also know they owed some money for juice at the start of the year and some money for juice at the end of the year. So the first thing I'm going to do is a juice purchases account, and juice is going to be an expense. So I know the amount spent on juice somewhere is 1,500, and that's come from the receipts and payments account, and it goes on the debit side because it's an expense account. I know that at the start of the year, this business owed an amount for juice of 150. So at the start of the year, that's a liability. So it goes on the credit side. And if you think about the logic, it's going to be included in the 1,500 that we spent, but it actually belonged to last year. So we need to reduce this 1,500. Got an amount owed for juice at the end of the year of 200. That's going to increase the expense of buying juice. And also, if we think about the logic at the start of next year, that's going to be a liability again of the business. Okay, balance off the accounts as we've done before. 1,700, take away 150. The amount that needs to go to my income statement is 1,550. And now life's pretty easy. We know what our juice sales were from up on the receipts and payments account. So I put that in as being my sales figure. It's just a bog standard income statement from now on. I know my opening inventory because it's written up here. I know my purchases of juice because I've just calculated them. Make sure in an exam question you don't put this figure in, but you actually calculate them if there's any accruals and prepayments. I put in my closing inventory, subtract the closing inventory to give me my cost of sales. I've then got a gross profit, and very often that's where you'd finish. But in this example, there's also a juice seller who got paid 500. So we'd include them as a normal expense. And there we have it. We have the profit. That profit will then be transferred as part of the revenue to the income and expenditure account we'll do next time. Okay, thanks a lot, guys. You've got a question to do about the running club, and I'll see you very soon. Bye bye.